Hey, everybody, this is just a supplemental podcast to kind of go a bit further about something that we talked about during our first inaugural podcast. One of the things that we talked about is how we're not in the market right now because we're missing one of the legs of our stool. If you'll remember, we say that we have three core fundamental rules that we make up a three-legged milking stool platform to investing. Okay, three core rules. And those three core rules are, how's the company doing? And that makes sense. I mean, are they making a profitable widget? Is the guy running the company doing a good job? How is the company doing? Okay. The second one is, what is the tone of the market? And let me give you just a really bad, extreme example to give you an idea how you can gauge the tone of the market. 9/11. 9/11, we had planes fly into buildings. That totally disrupted the markets. And scared investors half to death, and there was a massive sell-off. So what is the tone of the market? Is it generally upbeat? Is it generally pessimistic? Is there something volatile that's going on in our government or the world that's causing things to be unstable? What is the tone of the market? And again, that kind of makes sense too. And the third and final one is something that we call technicals. Now, here we are in a program that we have linked on the resources tab. It's called Worden, and Worden is I would say it's probably a 2 minute delay connection to the markets. You can actually see what's going on with a stock or the market in general within a 1 to 2 minute time frame from it actually happening. And what we're looking at right now on the screen is the S&P 500. These are 500 core stocks within the overall market that gives us a good general snapshot of what's going on in the market. Now, remember last week we talked about in the technical phase that we like to draw a line across the peaks of our movement and a line across the valleys of our movement. So here we are on the screen. I got a line across the peaks of my movement, and that line is called our line of resistance. And I got a line across my valleys, and that line is called my support line. And what you see is it goes up, it bounces off our line of resistance, and it comes down, and it bounces off our support line, then it comes up and bounces off our line of resistance, and so on. Well, here we are. This is us right now. This was today. This is the day before yesterday, or that was Friday, actually. Here was Thursday, and etc. Each one of these little lines represents a single day. And you can see these days are above our previous line of resistance. And they're just kind of hovering there. They're just kind of moving sideways. They're not really going up. They're not really going down. You can see we tried to turn down, but then we kind of bounce back up. And we're doing this, what we call sideways movement. The market is moving sideways. That's what we refer to it. So until this either goes up on high volume, I'll explain that in a minute, or dips down below and starts to give us a more expected downturn, okay, we're not going to really do nothing because we don't know what it's doing. Okay, so one of the legs of our stool is missing, and that is our technicals. They're not lining up. And when any one or more of the legs of that three-legged stool is not there, we don't even consider being in the market. We do what we call stay in cash. We keep our cash in our trading account and we go spend time with our family, which is perfect because this is, the Christmas time frame. We just got rid of Thanksgiving. Now, one of the things that is going on in the market that could have a lot to do with why we're just kind of hovering up here and we haven't tapered downward yet is something that's called window dressing. You see, at the end of the year, these mutual fund managers have to prepare something called a prospectus. They have to report back to all their investors to say how wonderful that they did so that they keep their money in those mutual funds. And so what these mutual fund managers tend to do is shift funds around from one stock to another stock and try to put them in name brand stocks. Okay, so they could have had them in one stock that was doing pretty well, but nobody really knows who they are. But they say, okay, well, now we have to do this window dressing thing. We need to give them some name recognition. So we'll take it out of this and we'll put it in Amazon because everybody knows what Amazon is, or Netflix, or Priceline. And they'll give them some name brand recognition towards the end of the year. Well, that movement, that shuffling of stocks and monies from one stocks to other stocks, we think is what's having a large part impact on what's going on right here. Okay. However, I can tell you there's a lot of pessimism in the market. I've been listening to the news all day today. They keep talking bubble, 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 and so what that usually indicates is we should be turning downward. What we're looking for though is movement on high volume. So let's scan down here to the bottom of our chart. I'll show you what I'm talking about. See this big red spike? That's a lot of volume on one single day where the majority of everybody was selling off. And if you follow that line up, you'll see that's what triggers a sell off from our high point. And what we have is several days. We have 5 days of heavy, at least one day of heavy sell off, 4 days of pretty decent movement, followed by one good day, followed by 2 more bad days, followed by one good day, followed by 2 more bad days. And this is a good progression that we can see. By the same token, if you move up to this other end where we saw this incline, you could see we had 4 good days, 1 bad day, 5 good days, 1 bad day, 4 more good days. And so that's heavy volume moving in one general direction. When we move backwards in time, look over here. I got 7 days, followed by 1 bad day, followed by 4 more good days. That's movement in one direction, and you can see what that does to our graph. Here we are again, movement one direction, and you can see what that does to our graph. Movement one direction, you can see what it does to our graph. Well, when we come over here to our current time frame, you can see my volume is just kind of, it's mixed. 3 good days followed by 3 bad days, followed by 2 good days, followed by 1 bad day, and it just kind of making this lateral movement. So the market's what we call moving sideways. I heard one particular investor call this a squirrel market, meaning it's very difficult to predict, and I think that's a really accurate term. And so what we do in those typical situations is we stay in cash. We don't invest our money. If you had bazillions of dollars to invest, well, you might take a few risky type approaches to some stocks that look like good investments. But when you don't have bazillions in cash, like you and me, we need to do the smart thing and hang on to our cash. So what we're doing is we're waiting for high volume to push this up and create new trends, or the prevailing pessimism that's in the market and in the news to drive it back down to its normal trading range. And you can see what it normally should be doing by looking at that chart. So hopefully that'll give you just a tidbit more of information. We'll go more into these technicals as we move further. Otherwise, we go in and actually record a podcast tomorrow, our lengthy podcast with Tanner, and we're going to get more in depth based on what we talked about during our first episode. As always, if you have any questions, you can call us at 405-703-0704. And as always, our website address is investingtherightway.com.